Welcome back to Primary Source China Investment. Peng.guo and I are here with show W3. And we promise not to bore everybody with a long macroeconomics class, but there are a few interrelated items that we wanted to talk about from the macro side. And that starts with foreign exchange. And that relates to trade and interest rates. So we're going to get into all of those this week. And the first up is renminbi dollar. And renminbi dollar is hitting 3-year lows on a daily basis with no end in sight. You can see from this 5-year chart here, the 720 level, which was last hit back in June of 2020, we're right back at that. And if you're at that rate, you've had a huge depreciation just in this last 12 months. So, or actually less than that, maybe the last 8 months or so, or 6 months, because we've had about 12% depreciation. And that's the worst performance since 1994. And with the US continuing to hike rates, it's only going to exacerbate this as US dollar fixed income becomes more attractive. So, Peng.guo, do we have any reason, do we have any panic? Is there anything in the market that would lead us to believe something's going to go right, wrong, or change going forward?
Every time or every year, this is the same in the market. But for this year, it's pretty much clear. The US dollar is the same, and the Fed added interest is the same in the market. So especially in the early of the year, even the last year, everybody already know that. But really, most of the people not take the action to do it. So right now, we just see it's almost the end of the September, and we see the result, and people start to talk about that.
Yeah, I also see that a lot of listeners may not be aware that PBOC sets a rate and they have some volatility around that rate. Usually it's like a 2% daily. If you look at the chart, and Bloomberg provided this pretty handy chart, you look at the pressure on renminbi right now for further depreciation is very, very real. You're hitting levels where the deviation from the PBOC peg rate is approaching 1.5%. So that means you're going to have further depreciation. The chart that we put up earlier, that looks like it's a very drastic move towards further depreciation. And it does look like China is lowering interest rates, US is increasing interest rates. So that's going to give further pressure for depreciation.
That's right. And China and the US, I think right now they really have the different cycle, especially like the monetary policy. So China is still a little bit quantitatively easy, but the United States, they're already tied in the market.
Yeah.
So that's really reflect in the both market, in the short term or in the mid term. For the China, if you see the US dollar and the renminbi exchange, actually I think it's very easy because the currency is great for the trend investment or movement. At the end of the March, this is still in the downtrend, but it's obviously you see the monthly chart. So we don't know which day they probably get a depreciation, but based on my knowledge or my experience, nobody do anything for the renminbi depreciation.
Yeah, it's sort of snuck up on everybody. And now we're seeing it in the trade numbers as well, which is the second topic. You're seeing exports from China to the US is up 12.9%, and exports from the US to China is only up 1.6% as US products become more expensive vis-a-vis this exchange rate. You can also see that China export growth is slowing, still above pre-pandemic level. And if you look at the monthly data, the August print was actually a negative number. And we could argue that COVID spike you're seeing in that chart was the anomaly and we're sort of back to normal. But remember, imports from China are impacted by price. Although China has avoided a lot of the inflation that we're seeing in the US, China is exporting more value. It's not exporting more product. While price is going up, volume is not going up. So US is importing less volume, more value from China.
Yeah, that's the traditional theory related to the currency about the goods. In the short term, in my opinion, that is very strong for the trend. So RMB depreciation won't be stopped. So that is also bring another topic like the Hong Kong market. They have the renminbi futures. So
Yeah.
that would be very hot right now. Even like a daily movement is much bigger than some stock or bond. So people really get shocked for those kind of things.
Yeah, that's offshore renminbi is it as the proxy for onshore renminbi.
That's right. At least you can hedge some of the, like the risk. Yeah.
Yeah. The final point on trade is probably a lagging indicator of directionality for currency. So we're probably going to see less exports from US to China as US products are becoming more and more expensive on the mainland, and probably see more exports from China to the US as those products look a bit cheaper. So the final thing is rates. What's going on with rates? The China 10-year is at 2.7 and the US 10-year is at 3.7. Okay, so you're getting more yield for your 10-year treasury in US dollar than you are for your 10-year treasury in renminbi. Now, if you were a US dollar holder, you'd be in a lot of pain because you experienced about a 14% decline in your foreign exchange. But recall at the beginning of the year, China was at 2.8, which is just 10 bips off where it is now. But the US was at 165 for the 10-year. So US has gone from 165 to 3.7, which is a massive move. So obviously that's going to have ripple effects throughout the economy.
So, and also if you see the both chart, they're all in the downtrend. And so when the price is in the downtrend, that's the yield is keeping getting up.
Yeah, for US, but China is basically flat.
That's right. Yeah.
China's basically flat. So if you're a Chinese investor on the mainland and you bought, your 10-year bond fund, you got exactly what you expected. You had some price volatility through the year, but you got your yield, and that's why you were invested in that particular instrument.
Nobody, I think, want to get such big volatilities.
Well, if you're a large institution, if we cycle back the clock, if we go back to the beginning of the year, if you're a large institution, renminbi denominated fixed income looked great, right? You were getting 2.8%, whereas the US you were getting 165. That looked great. You had a stable currency, but fast forward eight or 9 months, all of that has been taken away from the punch bowl or whatever metaphor you want to use, right? You now have much higher rates in the US, and you had some volatility in the fixed income market in your renminbi. So the story is completely changed, and this is an area when we started by this saying this is an area people are not really paying attention to, but this is where all the volatility is in asset classes that historically don't have a lot of volatility.
Yeah, that really means if you're doing anything outside or multi-country currency related asset, you have to use like a commodity producer strategy hedge in the market, or at least do some kind of the hedge for the principles. Otherwise, probably easily get hurt by this bigger volatility.
Yeah, historical volatility, renminbi dollar is like 3.5% a year. That's historical volatility. This year we had 14% depreciation.
So that drop is always fast.
Faster than appreciation.
Yeah.
That's one way
like
to look
jump
at it.
off from the building.
Yeah.
It's quick.
But we had that chart up before. This renminbi is done a round trip, spring or summer of 2000. It was the same level it's at now. So it appreciated a whole lot over 2 years, and then in 8 months it depreciated all of it back.
Yeah. I think right now it's really like the news or event driven strategy. It depends on like the Fed today before the meeting, they say something, they change all the asset movement. So the best way is still use the hedge strategy and wait for those guys to give some clear directions.
Yeah, and Fed has been very clear. Now, market participants may not believe what they say, but Fed has done exactly what they said they're going to do.
I think that would be good. That formed the new expectations in the market.
Right. That's why all the earnings and the equities are coming down. But that's another issue. So we're going to leave it there this week. Thanks for tuning in. We'll be back next week with a new show. Make sure you hit the subscribe button.
Yeah, thank you.